Hi, I'm Simeon Wallace, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. July has seen a script reversal for stocks. We've seen broader performance with the S&P 500 equal weight version outperforming the same stocks when weighted by market value. Now, July has moved away from the AI trades as the NASDAQ and emerging markets have struggled. Yet year-to-date, riskier segments of the market have outperformed. Bonds have struggled this month with concerns over higher interest rates from rising energy prices. Now that has pushed more interest rate sensitive bonds to losses for the year. The story for July has been the surge in oil, up about 30% for the month and 60% for the year. July has also been a respite for Bitcoin, helping recoup some of the losses from this year. July has seen a rotation in stocks to energy and steadier, more cash flow focused sectors, such as financial services, healthcare, and utilities. Now, the source of the investment in these sectors have been interest rate sensitive and AI heavy sectors such as consumer discretionary, communication services, and technology. The US economy is expected to grow solidly over the next year, even after the World Cup and tax refund boosts have faded. This is driven by steady consumer spending and elevated spending by businesses on capital expenditures and people on larger home projects. As a result, economists expect an increase in industrial production. Consumer spending has been surprisingly strong. Numerous bank CEOs noted on earnings calls that customers keep swiping cards and paying bills. Now, three forces are behind this healthy economic activity and forecasts looking ahead: the AI infrastructure boom, reshoring factories, and changes from the 2025 tax cuts. Now, tax cuts may turn into a headwind as their impact sets to fade into next year. Analyst estimates for hyperscaler capital expenditures over the next 12 months are approaching $900 billion. This is a 140% increase year over year. Yet there are potential constraints to this growth: access to electricity and potentially rising costs of financing. One key benefit from the emergence of AI is how significantly it lowers costs for founders to launch companies. We continue to see record levels of business applications. Real-time inflation data shows a mixed picture. Goods prices, which are here in green, jumped with the start of the Mideast war and continues to be elevated with higher energy prices. Yet services inflation, which we have here in red, are a larger part of the US economy. Those continue to cool. The result is that headline inflation in black has actually been relatively flat the last 3 years. Kevin Warsh became Fed chair in May with a message that favors focusing on preventing increasing inflation. With the war in the Middle East and his perspective, investors are pricing in at least 2 rate hikes over the next 2 years as a result. To sum up everything from today, here are the key takeaways. Markets have been rotating their leadership. While the economy has stayed strong with consumer spending, and expectations are that it will continue. We continue to watch oil prices and interest rates. With that, I'm Simeon Wallace, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.